Hello and welcome to Tax Chats. My name is Scott Dyring. I'm a professor at Duke University, and I'm joined today by my colleague and friend at UNC, Jeff Hoops. Hello, Jeff.
Hello.
And we're going to talk today about the global minimum tax. I'll give you a little bit of background, and we'll talk about some statistics, and then Jeff and I will discuss our opinions. As is always the case, at any point during our conversation, feel free to raise your hand and ask a question verbally, or if you prefer, feel free to chat your question. We are recording this, and I will post it on YouTube, so just be aware that if you say something, your amazing question might end up on YouTube, where possibly as many as 30 people might watch the video. Okay, so let me just start off by giving a little bit of background about the global minimum tax. If you have sort of been paying attention to the news over the last, I don't know, I guess it's been quite a long time now, 10 or 15 years, there's been a lot of news articles about how really big US companies shift their income to low tax foreign countries and end up paying like extremely low tax rates. And so you might hear that, Google paid 2% tax rate or something like that. And the objective, I believe, of this global minimum tax is to somehow stop those types of things from happening. So I thought it might be somewhat useful to give you a little bit of a background by just thinking about some numbers. So one thing that you might be interested to know is that if you look at U.S. publicly traded companies, in 2020, about 70% of U.S. publicly traded multinational companies have at least one subsidiary located in a tax haven. And that number has increased from about 40% back in 1996. So it's a trend that is increasing over time and pretty much going in one direction. You might also be interested to know that if you look at the amount of foreign income that U.S. multinational companies have overall, that number in the last few years has ranged between somewhere between 500 billion and 700 billion. So that's like the total amount of dollars that are at stake. Like in an extreme case, you might imagine that you tax 100% of that and governments could collect something like 500 to 700 billion dollars. It sounds like a
It's
big
it's
sounds like a big number, but it's maybe not huge, Jeff.
it's not just that you tax 100% of it, it's that it was all shifted as well. I mean, if you're talking about like what the scope for income shifted, it's as if the US doesn't ever actually sell to any foreigners, it doesn't have any factories abroad, there's no real economic activity abroad. All foreign income is just like artificially there because of income shifting.
Right. So when you think about what the policymakers are arguing, they're going to say something like, oh, poor United States or poor Germany or poor England or poor whatever country, we're losing out on some tax revenue because the income was shifted to low tax country and it should have been located possibly in our country and taxed at a higher rate. And the total amount that could be is something like between 5 and 700 billion. The other thing that is causing a lot of consternation among policymakers is this idea that the foreign effective tax rate is dropping over time. So if you look back in the mid 1990s, the typical company might have been paying 35 cents for every dollar of foreign income to some country someplace. And over time, that rate has dropped down to less than 20%. And that is driven in part by foreign countries lowering their tax rates. So Germany's tax rate used to be, say, 35% or 40%. Now it's 25%. And that's been a very common thing in many countries. And then the other part of this is many argue that that effective tax rate has also declined because of the income being shifted to low tax foreign countries. Jeff, what do you think?
Yeah, I think, I mean, we're talking about the global minimum tax. This is all to say, we've been talking about this for a long time as a as a country. The question is like, how big of a problem is it? Is I think what Scott's trying to get at, right? If we're having this policy that its intention is to reduce income shifting, how much income is actually being shifted? And the answer is it's probably an increasing amount over time, but maybe not actually. I don't even know that we're sure about that. And for example, Scott just showed a graph that went down. He said, well, partly it's because tax rates are coming down, partly because maybe companies are shifting more income. I don't even know if we know what portion of those two components is creating that downward shift. But I think everybody agrees there is some income being shifted. The question is like how much. It might not be that much, and it might be a lot. And you can imagine that the people on either side of the, like in favor or against a global minimum tax, have different ideas for the magnitude of the problem.
Yeah, to kind of speak more directly, actually, to exactly what you're saying. There's a fascinating paper by Wright and Zucman who tried to decompose the decline in effective tax rates into how much was shifted and located in tax havens versus how much was just being driven by countries lowering their tax rates. And they argue that the amount that shifted has been increasing over time and has reached an amount of 50% of US multinationals recording their profits in tax havens by the last year of their study, which I think was maybe 2015 or 2016, something like that. And that is a big amount. Like, that's a huge amount, but that number is disputed. So there are others who have produced research that would suggest that it's not 50% of your income in foreign tax havens. It's some lesser amount. And then I guess the other
quite a bit.
Go ahead. Yeah, go ahead.
I mean, quite a bit lesser. A. B. I mean, I think it's super important. All of these, almost all these estimates, including the one you have, just came from before the Tax Cuts and Jobs Act, and there were substantial portions of the Tax Cuts and Jobs Act whose main purpose was to reduce income shifting. So we're setting current policy based on statistics that are drawn from the last time we tried to solve this problem, which seems a little bit crazy, right? The biggest thing that would make people shift income is because the US used to have the highest statutory tax rate on earth, and we don't have that anymore, and yet we're still basing our policies based on statistics from when we did.
Well, and here's an example of just how big these disputes are. So there's another study by Kimberly Klossing that suggests that the U.S. loses $100 billion in tax revenue every year. Okay, so $100 billion in tax revenue is lost to income shifting. There's another study by Leslie Robinson and Jennifer Bluen who argue that the number is closer to 10 billion. So 10 billion versus 100 billion, that's like 10 times bigger. And those numbers, like you mentioned, are all based on pre-TCJA amounts. And yet here we are setting tax policy based on what we know from those studies which don't agree. It's pretty crazy.
It could be even less than 10 billion if we think that the reason we shifted is because these high tax rates and the guilty actually might have done something. This tax thing that we passed in the TCJA that was intended to keep companies from shifting income.
Yeah, so what Jeff is referring to is there's an amazing new tax, which is commonly referred to as the GILTI tax, the Global Intangible Low Tax Income Tax, which is commonly referred to as GILTI. And the idea of GILTI was if you don't pay a certain amount of tax on your foreign income, then you have to pay an additional amount of tax to the U.S. to keep your taxes high. And at some level, that's kind of what this global minimum tax is all about that we're talking about today, right?
Yep, it's just like we're taking the GILTI global.
So why does it need to go global instead of just saying, hey, the U.S. did it and that's fine?
So the problem always has been that like when it comes to multinational taxation, companies are very, very clever at using all the different tax systems like against each other, right? So if I'm a US firm, I can recognize income here or I can recognize it in other countries. And so, when I've historically taught this in class, you say this is kind of an insolvable problem because it depends on all the different countries' tax rates and different tax laws, the tax base. And for sure, like we can't ever just like have one internal revenue code for the whole world, right? We're not going to have like a one world order tax rate. And so we can't solve this problem, is how I literally used to talk about that. And then just in the last year, we've been talking about this global minimum tax, where it is kind of like one tax rate for the whole world. And how it kind of functions is all the companies that, or the countries that sign up for it, have some minimum tax. And then if there are countries that do not sign up for it, that don't impose at least that much tax, the countries that do sign up for it will collect the difference between the lower rate and their minimum rate from the companies that operate in those non-compliant countries. So, I mean, it's like a big shift in thinking about taxes, about how, you can get more than 100 countries to sign on to an agreement to collect a minimum tax, and it's kind of a big shift in how to think about things.
So let's unpack what you're saying, because you're talking about how there needs to be cooperation because companies can just move their income wherever they want their income to be. And
So I didn't say there needs to be cooperation. One way to solve the problem would be to add cooperation or collusion, whichever way you want
yes.
to frame this thing.
Okay, but let's think about this. Why is it that companies can move their income from one country to another? Like, that's an important question to even think about. And I guess one reason that happens is because so much of income in today's economy is generated using assets that are intangible and can be very easily moved from one country to another. So if we backed up in time 50 years and we had giant companies like General Motors, it was more difficult for General Motors to shift their income to Ireland because they were making cars and they had to have big factories and produce steel and ship those cars from one place to another. So they needed large amounts of infrastructure. If we now look at what's happening in today's world and you have Google or Apple or Facebook or whatever company, the assets that generate the revenue are primarily intangible. And those assets can be, with the click of a mouse and a signature from a lawyer, moved from one location to another, and then the revenue that's created by those assets can be located. So that's like, the world has changed, but the tax world has not yet caught up. And so now what you're saying is there might need to be collusion or cooperation, whichever word you choose to use, among different countries to help stem the exodus of revenues from the high tax countries to the low tax countries. Am I getting that right?
Yeah, that's right. I think there's one other component is it's not just that these intangible assets are quite easy to move because they're like very light. I mean, they have no physical substance whatsoever, so you can send them wherever they want on their merry way with a click of a mouse or a lawyer's signature, as you say. But also, they're really hard to value, right? For tax purposes, it really matters how much they're worth. So if you're selling one thing to another subsidiary of a company, the value at which that exchange takes place is super, super important. We could talk more about that, but we won't. And you don't know the value. So it's not as if you just like could pass a law that says, okay, we're going to keep track of these intangible assets, we're going to adjust things. It's really hard to know how much they're worth and how much those sales should be booked at in the company's tax records. And as a result, it's really hard to tax.
One fascinating story that I'll just mention real quick is Uber, who, when they could see Uber was going to take off, they wanted to move their intellectual property abroad to the Netherlands so that they could set up a set of transfer pricing strategies that would help reduce taxes. Well, the transfer of the intellectual property from the US to Netherlands would be a taxable event based on the fair market value of that property. But of course, nobody knew what it would be worth. So they made an agreement with the IRS, known as an advanced pricing agreement. They sold their property to their own subsidiary, paid some tax, and then like a few weeks later went and got another round of funding. And it turned out like Uber was worth 100 times more than it was before they got the funding. And of course, they're not stupid. They sold the thing before the funding so that nobody would know what the value of the asset was. And then after the funding, the value became clear. And that's exactly what you're talking about.
Yeah.
Okay, so let's talk about cooperation and collusion. So if everybody decides to cooperate or collude or whatever you want to call it, every country, is this going to work?
Yeah, so I think if everybody does collude, there's a good chance of helping but that's a big if in my mind. I mean, so for example, you say like every country, it's as if like there's a Mr. United States and a Mrs. England and a Ms. Switzerland that all get together and like decide on this thing. It's not the way it works, right? So we send some like minister of finance or some person like this who has some authority, and they reach these agreements, but the agreements, number one, don't have a lot of details so far. A. B, they actually also have to be ratified, at least in the United States case, by an actual legislature, right? The Constitution gives the Congress the ability to tax. And so in the end, we are going to have to come up with at least 50 senators and a majority of the House to vote on a bill that would contain like these things that we're agreeing to.
So
And every country has to do that.
in other words, Janet Yellen can say in the New York Times, we agree to this, and we can send some diplomat to the OECD planning meeting and they can say, yeah, we'll do it. But that doesn't mean that we'll get the votes to actually make it happen. And every other country will be, to some degree or another, in a similar boat.
Yep. And it might happen. I mean, it's not necessarily the case we won't be able to make it happen. But even if we're able to make it happen now, there's this thing that I love to talk about, legislative infanticide. We're just like fascinated with killing each other's laws, right? So for example, the Republicans passed the Tax Cuts and Jobs Act in 2017. And when Joe Biden was running for president, he promised to overturn like every facet of the TCJA of the Tax Cuts and Jobs Act, because that's how you get elected. You vilify your opponent and say everything they did was bad. Well, for sure, when whoever runs for president and whoever's running for Congress next time around, they're going to try to overturn every democratically passed tax. And if it's a global minimum tax, they're going to talk about how we like ceded our sovereignty to this one world order and how we don't need to be part of these big horrific groups of nations, like taking away the United States's ability to tax itself. And it's a pretty fragile situation, right? It's not just the United States facing that, but it's every other country as well. Because just as soon as the UK Parliament changes hands, or the US Congress changes hands, or some other large country changes hands that has a lot of multinational corporations, if they renege on their agreement to collude, then their companies are going to have a competitive advantage, be paying less in tax, and they're going to be right where we began with. I mean, these cartels are like very, very fragile things. So you just get one defector and it just all goes away.
Let's talk a little bit about not just the fragility of the agreement, but the complications in administering something like this. Because the reality is there's not going to be one global tax authority that then oversees everything. This is going to be kind of like a series of treaties or agreements where each country, in theory, does their part to regulate the multinationals that belong to their country. So if a U.S. multinational is operating in the Cayman Islands and doesn't pay enough tax, the U.S. will collect a minimum tax of whatever it happens to be. And then, I guess in principle, those extra taxes that are collected would be divvied up among the countries that have some claim to them. So maybe France would say, hey, we want some of that minimum tax, and maybe, Spain or something. And there will be a series of treaties, I believe, at least my understanding, that would sort of help determine how this extra surtax, or the minimum tax that's collected, gets distributed. I can't imagine any problems that could happen in that kind of a system. I mean, it just seems like it's going to be really hard for companies to, first of all, agree in some kind of a treaty, and then ex post to continue to agree as the political winds shift. Would you agree with that?
I would agree with that. And then, I mean, it's not only how to share the revenue, but we talk about the global minimum tax rate as if the tax rate is the only thing that matters, right? So you have companies pay taxes based on the tax rate multiplied by the tax base. So companies might start changing the tax base. That is taken into account in most of these plans, right? That you can't just like adjust your base and provide tax holidays to get around this. But another march along which countries might respond is tax enforcement, right? You just don't enforce as vigorously, and that also can cause problems. So it's not nearly as simple as it might seem. There's going to be a lot of collusion required, an ongoing commitment to this that's all generated by the politics of a lot of different countries, and it might work. I mean,
let's suppose it worked. Like, let's
Yep.
suppose it works perfectly and every multinational company ends up paying at least 15%. Um, how much revenue is that? Like, if you're in the US, it's not like that much, right? Because we already know that US companies are already paying on average about this much, right? Now there's some companies who are paying lower, right? So Apple might be paying 5% and, you know, Avon or somebody might be paying 25%. But so the Apples of the world might pay a little bit more, but if the Apples of the world paid a little bit more, it's going to be somewhere taking their rate from, say, 10% to 15%. It's not going to be taking their rate from 10% to 35%.
Well, when you say Apple pays 5%, what do you mean by Apple pays 5%?
So if you take Apple's, I mean, I don't know what it is right now. I'd have to go look. But if you look at some of the really big tech companies,
Yep.
their amount of tax that they pay to foreign governments on their foreign income is less than 15%.
So, but is that 15% of financial accounting income or tax income?
Yeah, well, in theory, it would be tax income, but you can't observe that. So I guess I'm looking at the statistics I'm giving you are
The,
based on
the
financial accounting
statistics we
income.
throw around are generally based on financial accounting income. Um, and I think these companies' tax rates, I mean, the tax rate on taxable income is going to be 21% minus
Well,
tax
so
credits.
I mean that I think that gets to an important issue, which is you talked earlier about rate and base. A lot of people might not know what we mean when we say rate and base. The rate is like the percentage that you pay of your income. The base is how much of your income actually gets attached to that rate. And so what you're
And
saying
what
is whatever your base is, you're going to pay whatever the rate is. That's just kind of math. The trick is if I'm a country and I can exclude certain types of income from the base or from the amount that gets taxed, I might end up paying an effective rate, which is the tax I pay divided by my accounting income, that's much lower than the statutory rate because I excluded a certain amount of income from the base. Is that what you're talking about?
That's part of what I'm talking about. And some of these plans have included not necessarily this global minimum tax, but some of these plans have included, like including financial accounting related constructs in the base itself.
Right.
So when we just say like a 15% global minimum tax, it's way more complicated than that because like 15% of what? It really actually matters because Apple pays, minus tax credits with some exceptions, but it pays 21% tax rate on its taxable income. We just don't ever think about that because we don't observe taxable income. We say 5% because 5% of financial accounting income, but we don't tax financial accounting income.
Correct. In fact, this is why a few years ago when Tim Cook was forced to testify before Congress about Apple's tax position, he could say with a straight face, oh, we pay 21, or at that time it was like 35%. We pay 35% federal tax rate. Well, of course you do, because every dollar that you have in the US that you report to the government, you're going to pay the statutory tax rate on. That's not the game. The game is to either find a way to get your dollars excluded from the tax base or to move those dollars to a country where the rate is zero. And the global minimum tax is designed to reduce the ability of firms to move their income on their own to a location where the tax base is low or the tax rate is low. But it doesn't stop potentially some countries from reducing the base. So that's kind of an interesting conundrum that will have to be dealt with. Okay, so any other last important things that we should mention before we run out of time here, Jeff?
I don't know. I actually, yes, I think there's one super interesting thing that I ran across a couple weeks ago. That there is this survey that the University of Chicago does. It is called the Initiative on Global Markets. They do this survey. They have like this panel of economic experts, and they ask them all sorts of different questions. And they're basically yes or no questions. And the economists, like super famous economists, weigh in. They say like I completely agree, I somewhat agree, I disagree, I strongly disagree, and they have to like say how certain they are about it. And there's a lot of issues you get like broad disagreement, and some issues you get pretty much unanimity. It's pretty interesting to see like where the expert economists agree and where they disagree. So back in a couple months ago, they asked the question, will a global minimum tax rate reduce profit shifting? So we've already talked about that. Without affecting investment. So that's a separate piece, is like you impose tax on corporations, you might raise some revenue, you could change their income shifting behavior, but the downside is like you might affect how much they invest. And there's pretty much unanimity. I mean, almost everybody in both the panel that's from the United States and from the EU either strongly agreed or agreed that a global minimum tax rate would reduce profit shifting without affecting investment. So that was pretty interesting. I mean, I don't know. Um,
So they must be
it's pretty
arguing then that these companies are earning a rate of return sort of above the required rate of return, like a
I think
supernormal return. And
a
so
lot of them would agree with that.
and so
Yes.
taxing that supernormal return, sometimes we would call them economic rents, will not distort behavior at all because it doesn't reduce the profitability of the investment below the cost of capital. And that's interesting that most people think that, and it's completely possible, right? But time
Yeah.
will tell. Time will tell.
I mean, I do think, I mean, most of what we've been talking about isn't will it work if it gets put into place, but will it get put into place and how long it will last? And those are two separate important issues to talk
So
about.
if you were a betting man, which I know you are because we bet on the UNC Duke basketball game every year, and I usually win. What would you say? Is it going to get implemented?
I bet very small nominal amounts on things like basketball games, like a lunch. But I'm also an extremely pessimistic person. I don't think it's actually going to end up happening. But I've often wrong. Like in 2017, I bet against the Tax Cuts and Jobs Act ever getting enacted, and it got enacted. Uh, I don't think it's actually going to happen, but that means it probably will happen.
So about a year ago, I was on a panel. You might have organized it actually, but I was on a panel with Leslie Robinson and Gabriel Zucman, who's a very influential economist that works in this world. And a panelist asked, or someone asked the panel the question, will there be enough cooperation to solve these problems of income shifting? And I'm like, no, not going to happen. And Gabriel Zuckman's like, oh, I'm more optimistic. You know, he's like, I don't know, a French guy, maybe French believe in cooperation. I have no idea. But he was like, oh, yeah, it's going to happen. I'm optimistic. And I was like, it's never going to happen. And I think if someone were to ask me again today, I would say, we took steps in the right direction, but I still don't think it's going to happen. And I think if you ask Gabriel Zuckman, he would say, it's going to happen. So I don't know. Maybe he'll be right. He's been more right than I have been so far.
Yeah, I mean, I think what's interesting is this panel of experts, they polled separately the US people and the EU people. And the EU people are way more positive on it than the US people. I think they're just like something about the US ethos of like individualism, and we're going to go it on our own, and we just don't believe as much in this thing. But the US is just one country of many in this agreement. So it might be that like this more socially minded ethos prevails, and we get a one world order of tax rates.
What do you think would happen if everybody agreed to do this and the United States said, we're out? Would
It
it
wouldn't work.
fall apart?
Wouldn't work.
Wouldn't work.
The US has to agree to it.
So the
Because
US has to be in.
I'd say the US has to be in, the UK has to be in, Japan has to be in, Germany has to be in. You have to have like the big countries with a lot of big companies to be in, or it just isn't going to work that well.
So it's got to be the major players, like the G8 or something like that. If they're not in, if any one of them is out, it's not going to work.
Probably, yeah.
I agree. I agree. Okay, it's time to wrap up. If anybody has any additional questions, happy to take them now. If not, we'll sign off and talk to you next week. Okay, thanks for joining, and we'll see you next week. Thank you.